In today's video, we are going to talk about a very unique strategy that is being used by hedge funds in US in the fixed income instrument market. Now, what is a fixed income instrument market? Now, we've all heard of this kind of instrument that gives more than FD, right? Usually FD gives you around 6 to 7%, but there are fixed income instruments which a lot of HNIs use, a lot of rich people use, which give you anywhere between 8 to 12%. So in today's video, we're going to look at how do rich people, which is your hedge funds, how are they optimizing for this strategy? And in the end, I will talk to you about some different strategies as well, so you'll be very interested to know, right? But what is this mystery, right? This fixed income instrument, also known as bonds, is something that a lot of rich people might use. Now, this is not something that is unknown in the world. If you look at Warren Buffett, who has been the master of compounding in his lifetime, he also invests heavy amount of his money into US bonds or US treasuries, as they call it, right? Now, these are again fixed income instruments, because if I have idle money, I am not going to keep that idle money in my bank account. So that is why what Warren Buffett does is he keeps it in an instrument that generates some kind of revenue. And right now, Warren Buffett has accumulated more than 4.89% of the total US bonds, which are equal to approximately $300 billion. But the biggest problem in India, even though the bond market is there in India and it's such a huge market, a lot of Indians, mainly retail investors, we don't know what the bond market is, what are the different types of bonds, and that is why we tend to shy away or stay away from the bond market, right? Even though we can get anywhere between 11 to 12%, we will still stay away from the bond market. So that is why today what we will understand is, first, what is a bond very quickly, what are the different types of bonds, and then quickly we'll go into the hedge fund strategy as well. So what is a bond? Think of a bond as an IOU. It is something that I have to owe you something, right? So for example, a bond is an instrument, a financial instrument, where in return for cash, somebody pays you a certain amount of interest and then the principal. So when does a company raise a bond, right? There are two ways. One is I can go to a bank, right? I can go to different banks and raise money from there, but the banks will give me at very high interest rate. They might give me 12 to 14%. So what these big companies do, they go out in the bond market and raise the bonds at slightly lower rate than the bank interest rate, right? And they raise it from people like me and you, and they also raise it from a lot of HNIs. So when they raise it from a lot of HNIs, what happens is I have invested, let's say, 100 rupees in this bond. Now they have a fixed system that every 3 months or every month or every year, they will pay me interest, and at the end of the period of the bond, they will give me the entire money back. Now, obviously, there are different types of bond with different risk levels as well. Now, one of the most common bonds that a lot of big institutions invest in is called as government bonds, or GSECs. Now, these are bonds that are usually issued by the government of India, which is predominantly very, very, very safe, which has low default risk, and that is why the yield on this is anywhere between 7 to 8%. Right? A 10-year GSEC, also known as a government bond, might give you anywhere between 7.5% to 7% annually. Then we have corporate bonds. Now, these are big companies that actually come into the market and issue some bonds in the idea that they can raise money and grow their business at a quite rapid rate, right? Now, these bonds are usually priced anywhere between 9% to maybe 11, 12, 13% as well, depending on the size of the bond, depending on the size of the company, and depending on the ability to pull money from the market as well. So that is what is called corporate bonds. Then we have state level bonds or state development bonds. Now, these are basically bonds that are issued by the state government. They might have a big power project coming, they might have a big railway infrastructure coming, or a national highway coming. So at that point, they issue bonds. These are municipal bonds or state level bonds. And again, they give you slightly better returns, more than your government securities, but obviously not as good as your corporate bonds, right? So these are some different types of bonds that are actually there. So before you invest in bonds, you might be thinking, okay, Shashank, what are the platform that I can use to actually invest in the bond market? So again, there is a very good platform called Stable Bonds. Now think of it as FD 2.0, which actually makes it better as compared to your local FD, where you get more power with the same peace of mind, right? Now, Stable Bond is very good because every bond is visible on National Stock Exchange or NSE. Now, most of the bonds here are senior bonds, means these are bonds that are backed by a real collateral. So that means the safety level goes up quite a bit. All of these bonds are either A rated or better, and they are actually evaluated by CRISIL or ICRA. Now, obviously, if you want to know more about these ratings, you can definitely check out stablebonds.com. The second very interesting thing about the platform is that when the stock market is either green or red, which keeps fluctuating a long time, Stable Bonds will offer basically your regular and fixed payouts, which usually what a bond gives. It gives you a regular and fixed payout so that you don't have to stress too much about things, right? Think of it like a salary that you're getting from these bonds. Now, I know that you might think that investing in bonds also might be very complicated, but today with the world of technology, everything has become so easy where you just link your PAN card and Aadhaar card, and then you can simply go and invest in the bond market, and you have absolutely no problem here as well. And if you have ever done an FD or an SIP, this is as simple as doing something like that. And the biggest secret here is that the same banks where I go and keep my fixed deposit, these banks are the ones that are heavily invested in the bond market. And if you look at the Indian bond market, it is greater than 45 lakh crore. That is how big the bond market is. Whether you're investing 1,000 rupees or 10 lakhs, the process is the same. So you can definitely go check out stable bonds, and they have a perfect monthly payout, quarterly payout kind of things. This is very good for people who are planning their rent, planning their EMIs, or just want some steady income stream, right? Now, here comes the hedge fund strategy that a lot of people use in the US, which is called the BOND strategy itself. Now, B stands for choosing the bond quality assessment, O stands for optimal duration mapping, N stands for net yield maximization, and D stands for diversification matrix. Now, obviously, this might sound complicated for a lot of people, but let me make it in a very simple format. Now, let's start with B, which is the bond quality assessment. Now, first things first, for all the beginners who are here, if you want to assess a bond, these are some guidelines that you should follow. A bond that is triple A, double A, or A rated, they are considered very good bonds. For example, a triple A rated bond offers highest safety but slightly lower yield. Double A, high safety, moderate yield. A, good safety, higher yield. But BBB goes to okay safety and highest yield, right? So if you are someone who's starting off in the bond market and you're doing this bond quality assessment, I would stick to triple A, double A maximum, and maybe even go to A, because absolutely not a problem if you go, and you can check out all of this on stable bonds as well. Next, if you look at the fundamental analysis of these, it is always good to look at these four metrics. Number one is the debt to equity ratio should always be lower. Interest coverage ratio should be greater than 3. What is interest coverage ratio? That means the company should be able to pay its interest 3 times over. It should have enough money. If my interest is 100 crores, I should have at least 300 crores to pay that interest easily, right? Or else there is a problem. Next, you need to look at the history of this bond, if there is any past defaults that they've actually done. Number four, you should also look at the business and say, is it a stable business, or is there a lot of cyclical abilities in this business that can actually create a problem, right? And next, we will look at the O of the bond, which is called optimal duration matching. Now, this again is called the interest rate strategy, and let us explain how the professionals do it. Now, the bond market is inversely proportional to the interest rates. So, what the professionals basically do is that when the interest rates are expected to fall, that time you go and buy longer duration bonds, which are usually 7 to 10 years. Why? Because when interest rate falls, the bond price actually goes up, giving you very good capital gain and interest on good bonds. But the same thing, when you feel that, okay, now the RBI or MPC is going to increase the interest rate, that time you buy shorter duration bonds, which is 1 to 3 years, because then you can invest and reinvest those bonds at a higher rate once your money comes out of maturity, right? And this is why it is very important to keep looking at the repo rates and how it affects the entire ecosystem. Next, there is a bonus for this strategy, which is also known as a laddering strategy. Now, instead of putting all your money at one go, start phasing your money out. Let's say you have 100 rupees to invest. 25 rupees or 25% will go into 1 year bonds, another 25 in 3 years, another 25 in 5 years, another 25 in 7 years. So that way you will get regular payouts, and you're investing at different maturity periods, and also you're hedging your risk completely by doing this laddering method. And that is why I feel that is a very good bonus tip for all of you guys. Now comes the net yield maximization, or also known as the tax adjusted return strategy, right? Now, here we have a couple of things. The formula for this is the after tax yield should be equal to the gross yield into 1 minus tax rate, which basically means that if you are looking at professional strategies, then either go for a tax bond arbitrage, right, which is a tax free bond. Usually tax free bonds come somewhere between 7 to 8%. And if I am in the higher bracket, I don't pay any interest rate on it, or I don't pay any tax on it. That usually pays me a good amount of return on that, right? Second, buy bonds at a discount to face value and hold it more than 1 year to get good benefits on long term and short term. And then if you have an HUF, I would strongly suggest you buy these bonds under the HUF's name to route the money from there and to work on that tax bracket. So that makes it very efficient for you on the net tax yield maximization, right? Now, coming to D of the bond, which is also known as diversification matrix or the risk management strategy. Now, remember, I already told you that you should do a laddering approach, 25, 25, 25, 25. But now let's understand how do we do a deeper diversification into the bond strategy. For this, we have 2, 3 different versions. One is a sector diversification, So 25% into government bonds, 25% into banking and financial services, 25% in infrastructure bonds, and 25% in corporate bonds. If you do this, you are automatically well diversified in the bond market. Now, coming to duration diversified, which I already told you, here you can adopt this strategy, which is 30% short term, 40% medium term, and 30% long term. This will actually help you create a good mix. And then if you want to look at credit quality diversification, then again you have this, which is very important: 40% in AAA and AA plus, 40% in AA and AA minus, and 20% in A plus and A. Do not go towards B, then you get into a big problem, right? Now I explained this for you, but let me go more deeper and understand how you can actually implement this. Let us take an example of a 10 lakh bond portfolio strategy. Now, if I have 10 lakhs, first thing I would focus on is asset allocation. I would put 3 lakhs into government bonds that yield somewhere around 7.5%. This is basically to create a safety foundation. Next, I would invest another 3 lakhs into triple A corporate bonds, giving approximately 8.5 yield to provide some stability. Then I would invest 2 lakhs into AA corporate bonds at 8.5, and then I would invest another 2 lakhs into tax-free bonds at 8% to optimize my tax proportion. If I do this perfectly, my approximate portfolio yield should come to around 8.3%. But there are good AA bonds that actually go for higher yield rates. I think I would focus on that as well. Now, if you look at duration strategy, how would I play this? I would put 60% of my money in 5 to 7 year bonds, and I would put 40% of my money in 2 to 3 year bonds to again optimize my flexibility. Now, there are some other rules that you need to follow when you're investing in the bond market. For example, I call this the risk management rules. Never exceed more than 20% of your money into a single issuer so that you reduce your risk and dependence on one bond. Always diversify across different sectors and durations. Monitor the credit rating regularly and see if the credit rating is dipping. Are they coordinating with the credit rating agency or not? Have a 6-month liquidity buffer in short term bonds and rebalance annually depending on the interest rate outlook that you have. So if you do this, I think you have a perfect step-by-step framework with an implementation strategy on how you can actually invest in these bonds. Now remember, a lot of people in the market just look at the stock market, and I've constantly kept telling you this, that you should also look at investing in the bond market to keep yourself in a very good stabilized zone. Now, this is the bond investing mastery for Indian citizens. So if you have understood this and you like this, let me know in the comment section below. And if you want to understand more, please put your comments as well. Okay, this is me, Shashank Udupa, signing off. Take care. See you guys. Bye-bye. Investments in debt securities, municipal debt securities, or securitized debt instruments are subject to risks, including delay and or default in payment. Read all the offer related documents carefully.